Hey guys, it's Wayne Scott, tax strategist here. As a real estate tax planner, I'm focused on providing solutions to real estate investors in the New York tri-state area with tax compliance, business consulting, and high-value tax planning strategies to save them thousands of dollars. The reason I'm doing this video is to talk about QBI, Qualified Business Income Deduction, under Section 199A of the Internal Revenue Code. So for tax years beginning 2018 through 2025, eligible taxpayers may be entitled to a deduction of up to 20% of QBI, subject to certain limitations, of course. QBI is determined from each qualified trade or business of the taxpayer, and I'm not going to go into the details behind that, but there's more to it than that. Certain businesses have limitations based on whether a specified trade or business, so that's for another video. Right, but for now, the deduction is calculated on Form 8995 and is also reported on line 13 of Form 1040. Now, generally speaking, income from rental property held for investment purposes. All right, so if you live in your home, for example, your primary residence, and your goal is to speculate, well, you live there, but you also have maybe it's a multifamily unit or whatever. You rent part of it as an investment, right? So those people, they generally are not eligible for the QBI deduction. However, they may qualify if the rental activity is operated as a real estate business. And additionally, rental or licensing of tangible or intangible property to a related trade or business qualifies for QBI, right? Well, as long as the businesses are under common control. So for real estate, there's a rental real estate safe harbor rule that basically would allow, irrespective of other factors, would allow the QBI deduction to take place. Now, the IRS has issued guidance on this and rules about, what safe harbors exist to allow your rental to qualify, even when it normally would not. Now, some of the provisions require the following. You have to have separate books and records, and the books and records must reflect income and expenses for each rental enterprise. Each rental enterprise must have its own books and records showing income and expenses, right? And there's a rule about, if the rental enterprise has existed for less than 4 years, 250 hours or more of rental services are performed per year with respect to the rental real estate enterprise. And if the activity has existed for at least 4 years, in any of the three of the 5 consecutive years that ends with the current year, 250 hours or more of rental services are performed per year with respect to the rental enterprise. And then the last one is the taxpayer must maintain contemporaneous records. So maintain the records as you go along, logs, and time reports showing hours of services performed, description of services performed, dates they were performed, and by whom. Those are all important. And then even if the enterprise fails to satisfy those safe harbor rules, it may still qualify for the QBI deduction, if it otherwise meets the definition of a trade or business. So there it is, guys. Just a little bit about QBI deduction as it relates to real estate. If you have any questions about this topic or any other issue that comes up along the way, give me a call. My name is Wayne Scully, and I'm with W. Scully CPA PC, working around the clock to save you a chock full of money, time, and stress. All right. Make an appointment by visiting www.wscullycpa.com. That's www.wscullycpa.com. Or call me toll free 855-254-1892. And if you like this video or not, share your comments. Let me know how I'm doing, what I need to do better, and what information you may want to hear about. All right. So thanks again, guys. Take care.